This is Derek Schwartz, host of the Advisor Lab by Scion. On today's episode, our guest is Seth Streeter, Chief Impact Officer and founder for Mission Wealth. Well, this is awesome. I'm super pumped to have you on the Advisor Lab today. So thank you for joining us. And I think the audience is, they're going to get a lot out of this. So I appreciate it. Maybe start, Seth, just talking a little bit about just the founding philosophy of Mission Wealth and how that influences your approach in terms of internal succession planning.
Sure. Well, it's a pleasure to be with you, Derek, and your community. Mission Wealth, we founded 23 years ago, and my co-founder, Brad Stark, and I founded it really on the premise of we want to treat others the way we'd want to be treated. And that was kind of our North Star. And so we have a comprehensive service approach. We're an RAA, we're a fiduciary, and we make sure we provide integrated services for our clients proactively instead of waiting for them to ring the bell on service. And that's kind of been our guiding light, create a culture where people can really shine and where there's a ton of career advancement for them, but also where we have a lot of fun and people feel supported, not just for their doings, but as human beings as well.
You talk a lot about your culture, I noticed, through like your website, LinkedIn, and I think it's a pretty distinctive culture. We work with a lot of RIAs, and I know there's a lot of lip service paid to culture to some extent across the world of corporate America and globally. Maybe just talk about what the key components are when it comes to the core, your culture, and how do you maintain that across your entire organization?
Sure. Well, I'm the Chief Impact Officer, so I have the joy of being the champion of our culture, which is something that, we have to nurture every day. Culture is something that you live and breathe every day, and it's something you can talk about, but frankly, it's something that can only really be felt, by the team, by the clients, by the folks in the community that you're interacting with. So the way that we cultivate our culture at Mission Wealth is we do a lot of listening. So, we lead retreats every year where the whole team gets together and we'll do listening exercises. Not level 1 listening where you listen to reply, that's lowest level. Not even level 2 level listening where you listen to understand, but level 3 listening where you try to listen for what's not being said. So when I have someone from the investment team speaking to the ops team, speaking to compliance, speaking to marketing, we want to make sure that people feel like they're heard, they're appreciated, they're valued, and we do a lot of listening. I would say that that's one of the kind of the core elements of having an outstanding culture. We also do a lot to give back. So we give out service awards. We have volunteer time off where we actually pay our team to go do volunteer projects. We celebrate the impact that different team members are having in the community. At our retreats, we do volunteer together as a large team. So we try to give back and have that service orientation, not just toward clients, which of course is the core of our business, but toward each other as valued teammates and toward the communities that we serve in.
Now you're RIA that manages roughly 7 billion total AUM.
We're about 8 billion right now.
8 billion right now. Congratulations. And you started in 2015, correct?
No, 2000. 2000.
Oh, 2000. Sorry about that.
Yeah.
So I know you've been a recipient of a number of awards as an RIA, top 100 in Barron's in 2021, Forbes America top RIA in 2023. Financial Times. There's a number of awards, and congratulations to your success. As it relates to what you just talked about with culture and listening and giving folks recognition, and so much of that, of course, it is important. We're also in this somewhat of this Me Too culture. How do you balance that? When you talk about wanting to build people's confidence and recognize them, but also holding people accountable, understanding that there's consequences when you're not going along with what you set as the template and culture. Is that a challenge? How do you deal with that?
I think it's an ongoing challenge. It's something that we've really addressed head on with our structure and our technology. So we use the EOS, Entrepreneurial Operating System, across our whole organization. So we have clear language that every department, every team member uses. We know what our rocks are for the quarter, what our weekly to-dos are. We have a vision traction organizer that we look out 3 years ahead. So I think clear language and clear management structure has been really beneficial. And then we use technology for everything. So we can look up any client any day of the week and know what services they're receiving, to know if there's any lag time, to look at the quality of those services. So we've really built out some customized Salesforce dashboards to really stay at the pulse of service. So I think culture is wonderful. People feel supported. There's tremendous career advancement. But we also have technology to make sure people are accountable. And we have amazing training and mentorship programs as well. So that's one of the benefits as firms get a little bit larger, is you have associates who can be partnering with associates 1, 2, 3 years ahead of where they are. So they're getting mentored by their peers. They're learning from each other. We're sharing best practices across all of our diamond teams nationally. So we really have an environment and an ethos where people feel supported, but they also feel accountable because we're all part of this larger mission that we want to serve more families nationwide.
Now, you have how many roughly IARs or advisors that work within the family right now?
So we currently have about 60 advisors at Mission Wealth and approximately 60 operational folks. So we have 120, 125 total team members today. And those advisors all work on teams. So we use the Angie Herber's Diamond Team model. So those teams are regionally focused. And within the team, there's very clear career advancement path from associate to advisor to lead advisor to managing director. So people understand where they are in the org, what the opportunity is for growth, and they never feel like they're competing with the person next to them because the compensation model is structured on a team orientation.
So everyone is given a very clear idea of what their path is, what the milestones are they need to achieve in order to continue on that path, and what they end up achieving is not coming at the cost or expense of their peers. So everybody's really aligned perfectly well. Is that
100%.
right? That's great. When it comes to wellness and spiritual health and all these other things that are becoming so important in our society, where so much is constantly being documented about mental health issues, how are you incorporating that into the experience for your clients? And is that something that you just recently started to adopt, or was it at the core of what you were thinking at the beginning?
Sure. Well, I was fortunate to work with Fidelity about 4 years ago when we designed what we called the advice value stack. And so if you think about a pyramid like Maslow's hierarchy of needs, at the bottom of the pyramid is managing the money. And there's kind of two tiers of that. There's basic portfolio management, and I'd say there's more advanced portfolio management where you have ESG screens and alternatives and solutions around concentrated stock. The belief there is that's mostly a commodity, right? That's something that can be done for 25 basis points by a robo platform or Vanguard. The next tier, and there's 4 tiers, is achieving goals. So that's where the planning comes in. And within planning, I would say there's also 2 tiers. There's basic financial planning, which is retirement forecasting, cash flow modeling. And then there's more advanced planning that gets into estate planning, charitable planning, tax planning. And that's where advisors can add more value. But again, if we look at generative AI, I just met the head of Google's AI team this weekend at this conference I was at. It's kind of crazy what the future of AI is going to be able to do, even on the planning front. So what's above that? What's above that is when you get into peace of mind and fulfillment, helping clients actually have fulfillment, which is more than just achieving a rate of return. It's more than just the balance sheet looking a certain way. And so we believe that kind of Maslow's hierarchy of needs, that top level of fulfillment, is where we as advisors can add tremendous value. And so at Mission Wealth, we have something called Inspired Living, where we do provide life-centered planning to our clients, especially those clients that are going through transitions. So if someone has just retired, they've just sold their company, maybe they've empty nested, they're thinking about their purpose. They're thinking about their next chapter of life. And it's not just simply about saying, hey, you can spend $15,000 a month, Mr. Client, you're good. It's like, how are you going to spend your time? And how can we as advisors do that deep listening, use our EQ skills to help support them in designing that next chapter of their lives? That's something that we believe in, and we do inspired talks. We bring in speakers about every quarter to talk about these 12 dimensions of life or 12 dimensions of wealth, only one of which is money. And we've been doing this work for almost 10 years with our clients.
It's obviously something that's proven to be very successful, and you're getting great results from it. And that leads me to just talking a little bit about your clientele. I know from your website, you work with retirees, and of course, that's a bread and butter staple for all financial professionals and business professionals as well, but nonprofits, and then, of course, independent women. Curious for you, maybe talk a little bit about that. How did that become a niche or a focus, and kind of what inspired that?
Sure. Well, we realized where clients really are most receptive to deep planning, which is what we do, is when they're going through transitions. So life events. And, a lot of times you take a look at what are those major life events. There's, divorce and there's loss of a spouse, oftentimes leaving women independently needing to make their own financial choices. And if we look at wealth trends, we obviously know that there's a lot of wealth that's transitioned and transitioning from the baby boomers to Gen X, Y, and Z. And actually, by 2030, that will be the largest consumer household, and most assets under management will be in those generations, no longer boomers. So wealth is moving to women, wealth is moving to the younger generation. And so we need to make sure that we keep evolving our services to really be tailored to these groups. That's the type of advisors who serve them. That's the way we interact with them. That's the services that they want to receive versus what we think they need to receive. And so we've created these distinct niches around these different client types so we can best serve those clients that we have today and where we think more trending clients will be coming from.
And with that focus, how has that impacted the way you are bringing talent in to your company? Who are the type of people you feel like are best situated to sort of be able to kind of go along with that prioritization that you have in terms of the focus of your clientele?
Sure. Well, we, always are looking for top talent at Mission Wealth, but we are seeing that clients are really looking oftentimes to work with advisors that are like them. So it might be a female independent woman who would prefer to work with a female advisor. It could be someone from a certain geographic background or ethnic background. It could be someone who has, just some shared perspective on life. And so we're able to really try to diversify our advisory team so that we can really make those great fits. And that's not to say that, the average advisor can't work with a lot of types of clients. We all do. But there are some situations where the clients prefer having that relatability. And again, as there's more younger wealth holders coming into the practice, as well as women, we're looking for team members that have those listening, empathy, EQ skills. Those softer skills are becoming just as important as, the hard skills of being able to use the financial planning software and speaking about the markets and the economy. So I would say we're really leaning toward trying to find a very diverse group of advisors and other team members so that we can have more innovation in the firm, because more diverse ideas brings more innovation to the firm, and we want to always stay cutting edge. And B, be able to serve more clients that are coming from different backgrounds.
Let's shift gears a little bit. Talk about what your firm's approach is in today's market right now. A little bit of the big picture. Barron's ran their top 1,200 this weekend. They did some, of course, typical highlighting some advisor teams, and seemed to be a couple common messages or themes that came out. One was, we're not sure about 60/40. We can rely on that. We need to diversify a little bit outside of what was the common wisdom. Does your firm share that perspective, or is it left to the individuals in terms of how they want to approach the markets and with their clients?
Well, we do have some portfolios that are recommended portfolios that we put together for clients, these models. But of course, we will always customize it based on the client's need. We work around their existing assets. Some clients love emerging markets, some don't want any emerging market exposure. But we do believe in a multi-asset class approach. I would say one shift that's happened over the last 5 years is we are putting a higher percentage into alternatives. We're finding that alternatives really are a great diversifier outside the traditional stock, bond, cash, real estate allocations, and they can be great generators of cash flow. So we are, I would say, trending toward higher percentage in alt, which maybe 15 to 30% kind of maximum. And then we are, proactively rebalancing. We're using active and passive with a bias toward passive. And we're always trying to make sure we have a best of breed approach for our clients that's completely integrated into their financial plan. So every single client at Mission Wealth, 3,000 clients, we do updated financial plans every year. So that's one of the things we track. So we look at their whole balance sheet. We understand cash flows coming in, coming out. We understand their goals around how many years they want to work, what their tax situation is, what their estate planning goals are. We look at, multi-generations. And so we make sure we tailor the investment solution to the financial plan. We don't look at them independent of each other.
When it comes to the way you diligence and vet the different investment programs, the different money managers that you use, I mean, a big part of what an advisor's client is hopefully paying for is your due diligence. You're the goaltender, right? Keep the bad stuff out. Alternatives are often talked about because of some of the strengths such as diversification, low correlation, things like that. But also manager dispersion is a big topic. And this came up also in the Barron's piece. When it comes to investing in alts, there's a big gap in manager dispersion, which really requires RIAs and any financial professional to do their homework. A lot of RIAs listening, I think, have challenges because there's a lot of different ways you can go about it, whether it's going through a case, an iCapital, or doing it. Talk a little bit about how does your team handle that? Because that's an important process.
Yeah, Derek, that's a very important process. First off, we have a 12 person investment committee that is very, very active in the due diligence process. And when it comes to alternatives, we make sure that we lean on our due diligence partners to have to approve them before we would even consider. So we don't consider an outside alternative unless it's been vetted by our due diligence partner firms, some of which you mentioned their names. So we work in partnership with the due diligence firms. Hey, they've passed your test. They've looked at dispersion. They've looked at expense ratios, management tenure, et cetera. And then we as an investment committee, dive deep and say, does this have a need for our clients? Do we have something else that competes with it? Do we feel like they can have consistency, on the return profile? So that's how we do it. Really, it's an investment team-led process. Advisors give a lot of input, but the investment committee really has the discernment power, and we lean heavily on our due diligence partners to do a lot of the scrubbing.
I'm curious, Cerity, I'm sorry, it was Mercer, put out a white paper. They surveyed probably 2 trillion in AUM across private, family offices and RIAs. And the number one reason for firing a manager wasn't performance, it was volatility.
Mm-hmm.
Would you agree with that? Is that where you guys would fall? Like just you didn't expect the kind of drawdown, kind of bumpiness. It's okay if you underperformed here or there, but don't tell me you're a smooth ride and then, all of a sudden I feel like I'm in a 4x4 and I'm missing a tire.
Exactly. I mean, we stress test these managers and ask for them to show us their stress test scenarios. And, that's at the end of the day, we're advisors talking to individuals, setting expectations around the portfolio construction and what we expect it to do. So if there's this volatility that wasn't communicated to us, wasn't expected even under stress test scenarios, then that's not going to allow us to really, hold true to what we've shared with these end clients. So 100%. I mean, we really look at that, and we want to make sure that you don't need to promise the moon. Just be clear, be honest. Let us understand really what risk levels are in there. What are some downside scenarios that you haven't experienced but could happen? And then let us go through in our portfolio construction process and really determine the best way to blend these different positions together to ultimately help our clients achieve the life they want to live.
Makes a lot of sense. I think about what you talked about earlier with your internal succession planning, and I wanted to touch on this a little bit more and kind of shift into what's been going on in the RIA space with private equity money. I'm looking at an article that was Investment News, and I'm sure you could find 50 of them if you Google. This one was, I think, end of January. Why PE can't get enough of RIAs. And obviously, there's been an increasing amount of investment money going into the RIA space from private equity. Just looking at the number of PE-backed deals out there. How do you see this trend kind of influencing the wealth management industry at large right now?
Yeah. I've been in the industry 34 years, Derek, and it's been really impressive to see how much the industry has shifted just in the last 5 years. Largely, I would say, due to PE involvement. If we take a look at RIAs, RIA assets have grown from 2 to 9 trillion over the last decade. It's 30% of the overall advisory market. And PE has looked at that, and they understand how fragmented many of these businesses are and how most of them do not have a succession plan. So if you take a look at kind of the latest studies out there, only 18% of RIAs have confidence that their Gen 2 can afford to buy out, the founder, Gen 1. So the bulk of firms don't have a succession plan. And PE looks at this and says, hey, we can come in here, we can get these consistent revenue businesses and add value to these firms that don't have as deep of a bench. They don't offer maybe alternatives. They don't offer the strategy team support like we have with internal CPAs and estate attorneys and philanthropy experts. And 2/3 of all deals in the last 5 years have been PE funded. And there's about 300 deals per year that are happening. And there's been 150, I think, different investors in those deals. So there's a ton of PE actively involved. There's 50 to 75 that are, I would say, sponsoring the big wealth firms, but there's an extra, double that number that are investing in some way. So 15 billion has come in and it's not slowing down because they're looking at these trends with the bulk of these firms are under 80% of RIAs are under 500 million in assets. They have 1 to 2 offices and the owners are in their late 50s. That's average. So they have to figure out what to do. They don't have an internal succession plan. And so a lot of them are just saying, you know what? I can't compete on marketing. I can't compete on compliance. I can't compete on talent with the strategy teams. I'll just sell. The challenge is that can really impact culture. That can really, make an advisor's life not what they're used to as far as autonomy and control. So what we've tried to provide at Mission Wealth is kind of a Goldilocks solution in the middle where we are employee owned. We have 37 shareholders today. My co-founder and I started selling our shares when we were in our late 30s. So we've been doing succession since 2008. And we offer strategy teams, growth, operational support that the big firms do without having to worry about the cultural shifts that can happen when PE comes in. And I just want to say PE is not bad, right? Like PE serves a great function. The challenge, I think, what I've heard from my peers who are leading firms is they develop a great relationship with the PE partner and they are working well together. But that PE firm is going to sell 5-7 years down the road, in most cases. You don't know who your new partner will be. So you might have a great relationship for the next 5 years. You don't know who your future partner is going to be and how they want to change your service model, how they want to change your travel policies or whatever within your firm. So I think owners need to be very intentional about this thought process around their own succession strategy. Can they build it themselves? Do they need to partner with others? Do they need to sell to PE? And there's pros and cons to all three.
It's interesting that in this piece, they talked about years back, it started, they were looking for 5 billion and up, and now it's down to 1 billion. And this article talks about, PE is known for taking something distressed, dolling it up, getting a better multiple, and out we go, like you said, in about 5 years. Where RA business is not, they're buying quality businesses and they believe the multiple expansion is still in the mid innings, maybe because RIAs have been able to maintain their fees, but their costs have come down as most RIAs have adopted a lower cost business model with ETFs and things like that. But I guess the question is, there's clearly incentive for folks to want to take that money and maybe get out early, right? You have to have a long-term view. And even the folks that maybe are getting equity in your firm, right? Maybe they're like, well, gee, Seth, why don't we sell too? I can get rich now as opposed to later. Or not. There's some balance and challenge there, right? I mean, you have to really get folks to buy into a long-term vision. And isn't that always the challenge? Private equity is short-term. Even if you're in a public company, it's always about the next quarterly earnings. Has that been a challenge, and how do you manage that and really working with your existing people?
Well, we feel fortunate in that we've already had 9 separate partnerships, mergers, if you will. So we've been in this space for about 6 years now, and we've been able to learn a lot over the past 6 years of what these founders are looking for. In most cases, Derek, these owners love a few of the hats that they wear. They love bringing on new clients. They love serving existing clients. Some love marketing and some love investment due diligence, but they don't love the 12 hats that they wear and trying to spin between all 12. And I remember that because I wore those 12 hats. That's probably why I don't have any hair anymore. What it comes down to is saying, look, what are the resources that you really need to do great with your clients in the roles that you love doing? So, okay, you want someone else to handle state-of-the-art technology. You want someone else to do investment due diligence and trading. You You want someone else to do marketing and compliance and operations. So you and your core team can focus on serving these clients well and taking on, higher ideal fit clients. So that's where we're able to say, great, we've got an incredible growth story. We're growing about 2 billion per year right now in new deposits. Like the firm is hockey sticking because we have really strong growth channels and we have great support and operations teams. So we're able to take those hats off their plates, allow them to do what they do best, and we give a lot of autonomy. So we're able to say, yes, you're going to deliver certain services. So we don't let one advisor not deliver tax management services and another advisor to deliver it. We want to offer tax to all of our clients, estate planning to all of our clients, even life standard planning to all of our clients when it's a good fit. But we give them autonomy in when and how they deliver that, and we have a ton of support resources. So again, we're really trying to stay in this swim lane of, hey, we're growing 20% per year. We don't need to grow at the 40%, rates that some of these PE-backed firms are growing. We're being very selective in who we partner with. We're looking to take on about 4 new firms a year into Mission Wealth, so 1 per quarter. So we have a lot of firms interested, and we're wanting to be really selective about what geographies are they in? Do they do comprehensive planning? What is their investment philosophy? And then we feel like, it's 1 + 1 = 3. Like when you truly align together from the kind of cultural and vision standpoint, it truly is better for them as shareholders. It's better for them as professionals, and their team now has more career advancement. And it's better for clients because clients are getting additional services and a better overall experience. But it's not easy. I'm not trying to say it's easy, but that's
No,
kind of where we're residing in that swim lane in between.
it's not easy to get people to buy into something that requires more patience. That's just the way our society works today. But it is easy to see the results are typically better when it's not strictly about the transaction and the money, and it's about building something that's going to bring value to people's lives. And I think that you really laid out today, that's really at the heart of what you're doing. And I applaud you, really. Mission Wealth, there's not a lot of firms doing it like you're doing it out there, growing the right way. I mean, as you said, there's nothing wrong with private equity. It's an industry that gives a lot of people jobs, and does a lot of things. But I think when it comes to people's money and planning, the culture of the organization is so important. So that's great. Are there any other final thoughts you'd like to share with our listeners just about maintaining a holistic approach through your wealth management business, or just how to keep evolving in the changing financial landscape that we're in today?
Well, I would just encourage advisors to think about how you can move up that advice stack. So, how can we talk about values-based investing, which I'm sure many advisors do, and translate that into values-based planning, helping these clients have fulfillment across these different dimensions of their lives, not just speaking about the balance sheet, but about all these other aspects of their lives. When you're able to do that, that is a uniquely human peer-to-peer connection that is truly valued. And that's how you help people actually have true wealth, right? So true wealth isn't like in my TED Talk, I talk about it. Like it's not just having a lot of money, right? It's having relationships, it's having health, it's feeling a sense of purpose. So I think when advisors kind of rethink what their job is, are you laying bricks of portfolio management, tax planning, and financial planning? Or are you truly in the business of helping people achieve their dreams? And if you're in the dream building business, you're building a cathedral with your clients, they can feel that shared mission. They can feel that energy and that passion you have to truly serve them and their families. And I think that it's an opportunity for our industry to continue to evolve forward and go from head to heart and make a greater impact doing so.
I love that. The cathedral. That's a great analogy. Seth, this was great. I really appreciate you coming on the show. Really enjoyed it. I know the listeners will as well. So hope to have you back soon. Thank you.
Thank you so much, Derek. Really appreciate it.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Scion Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Scion Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Scion Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Scion Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.